Okay, so this is the second video in the series of video lectures for chapter number 13, interest rate derivative instrument. And in this video, we will talk about interest rate interest rate options. You already know, and we have discussed frequently, that an option is a contract in which the writer of the option grants the buyer of the option the right but not obligation to purchase from or sell to writers something at a specified price within a specified time period. So it is basically a right given by the seller, which is the writer of the option, to the buyer of the option to buy or sell something at a specified price and within a specified time period. The price at which the underlying contract may be bought or sold is called the exercise price, and the date at which it can be done is called the expiration date. Our focus is on the options where something underlying is the interest rate instrument or interest rate itself. When option grants the buyer the right to purchase the designated instrument from the writer, it's called the call option. And when the option grants the right to sell the underlying designated instrument, is called the put option, or simply the put. An option is also recognized according to when buyer may exercise the option. There are options that can be exercised at any time up to and including the expiration date, called the American options, and there are the options that may be exercised only at the expiration date, called the European options. An option that can be exercised prior to maturity but not on the designated dates is called the modified American, Bermuda, or Atlantic option. The risk return characteristics of the option. The maximum amount that an option buyer can lose is the option price. The maximum profit that the option writer can realize is the option price at the time of sale. The option buyer has the substantial upside return potential, while the option writer has substantial downside return potential. So let's talk in detail. Long call option means buying a call option. So if you are buying a call option, your upside potential is unlimited. So until this exercise price or the strike price, your profit is flat, which means you are losing that option cost. But beyond that, you can gain unlimitedly, right? So beyond that, you can, for a fixed price, you can buy the underlying whatever its price is. And the same is reverse for the call option seller. Its gain is limited to that option cost until that strike price, but it can go down as much as the price of that particular security increases. For the put option, the gain is limited to the cost is limited to the option cost until the price is above the strike price. But as soon as it goes below the strike price, your gain becomes unlimited, and same is reverse for the short put position. What's the difference between options and future contract? It's straightforward. Unlike future contracts, one party to an option contract is not obliged to transact. So the option buyer is not obliged. He has the right. The option buyer has the right, not the obligation to transact. The option writer does not have the obligation. Does have obligation to perform. So he does not have any option. He have to perform. In the case of a future contract, both buyer and seller were obliged to perform. Of course, a future buyer does not pay the seller to accept the obligation, while the option buyer pays the option seller the option price. In case of a future contract, the buyer of the contract realizes a dollar-to-dollar gain when the price of the future contract increases and suffers a dollar-to-dollar loss. For the options, they do not provide systematic risk-reward relationship. The most that a buyer of an option can lose is the option price, while the buyer of the option retains all the potential profits or the gains. Buyer option retains potential profits. The gain is always reduced by the amount of option price. The maximum profit that the writer may realize is the option price, and the compensation accepting substantial downside risk. So this is his compensation for accepting the all that downside risk we talked here. So it's this downside risk here and this downside risk. Sorry, this downside risk here. Both parties in a future contract are required to post margin. There are no margin requirement for a buyer of an option once the option price has been paid in full, because the option price is the maximum amount he can lose. But because the writer of an option has agreed to accept all the risk, he have to generally required to put up some option price received as a margin, right? So the option buyer do not put deposit any margin, but option seller do. Exchange traded versus over-the-counter options. Exchange traded options have three advantages on over-the-counter options. First, the strike price and the expiration date of the contracts are standardized. Second is, in the case of future contracts, the direct link between buyer and seller is severed after the order is executed because of the interchangeability of exchange traded option. The clearinghouse performs as a guarantor. Finally, the transaction costs are lower for exchange traded option than for the over-the-counter options. The higher cost of the OTC option reflects the cost of customization. So you customize the over-the-counter option as per your tailor-made needs, and you standardize and investment banking and commercial bank act as a principal. While the OTC option is less liquid than the exchange traded, the purpose of the OTC is not the liquidity, it's the customability, right? Exchange traded interest rate option can be written on fixed income security or an interest rate future contract. The former options are called option on physicals. For reason to be explained later, options on interest rate futures are more popular than options on physicals. I will go to this in detail. Now let's talk about exchange traded future options. There are future options on all interest rate future contracts mentioned earlier in this chapter. An option on future contract, commonly referred to as future option, gives the buyer the right to buy from or sell to the writer a designated future contract at a strike price and a time period during the life of the option. If the future option is a call option, the buyer has the right to purchase. If the buyer has the right to acquire the long future position in the underlying future contract. If the buyer exercises the call option, the writer requires the corresponding short position in the same future contract. Alternatively, if it's a put option on a future contract, then the buyer has a right to sell. That is, the option buyer has the right to acquire a short position, and the option seller will be holding a long position in the underlying future contract. As the parties to the future contract, future option will realize a position in future contract when the option is exercised. The question is, what will the future price be? So here the question is deciding about the future price. what future price will be long be required to pay for the future contract, and what future price will be short be required to sell the future contract. Upon the exercise, the future price of the future contract will be set equal to the strike price. So whatever the strike price is, the future price will be set to that. The position of the two parties is then immediately marked to the market in terms of the then current future price. Thus, the future position of the two parties will be at the prevailing future price. So, at the same time, the option buyer will receive from option seller the economic benefit from exercises. Let me go through an example to explain this. For example, suppose there is an investor who buys a call option on some future contract in which the strike price is 85. Assume also that the future price is 95 and that the buyer exercise the call option. Upon exercise, the call buyer is giving a lock position in the future contract at 85, and the call writer is assigned the corresponding short position in the future contract at 85. The future position of the buyer and writer are immediately marked to market by the exchange. Because the prevailing future price is 95 and the strike price is 85, the long future position, the position of the call buyer realizes a gain of 10, while the short future position realizes a loss of 10. The call writer pays the exchange 10 and the call buyer receives from the exchange $10. The call buyer who now has a long future position at 95 can either liquidate the future position at 95 or maintain a long future position. If the former course of action is taken, the call buyer sells his future contract at the prevailing future price of 95. There is no gain or loss from liquidating the position. Overall, the call buyer realizes a gain of 10, and that's his gain from the this future contract. The same we can go through the same thing for the put option, right? So let's suppose you are holding a put option at an exercise price of or a strike price of 85, but the price in the market is 60. If the buyer of this put option exercises, the buyer would have a short position in the future contract at 85, and the option writer will have a long position in the future at 85. The exchange then marks the position to the market at the current future price of 60, resulting in a gain to the put buyer of 25 and loss to the put writer of the same amount. The put buyer now has the short futures position at 60 and can either liquidate the short position by buying a future contract at the prevailing future price 60 or maintain the short position. Overall, the put buyer has a gain of 25. Remember, there are no margin requirements for buyer of a future option once the option price has been paid in full, because option price is the maximum amount that the buyer can lose, regardless of how adverse the price movement of underlying instrument. There is no need of margin. However, because the writer of future option has agreed to accept all of the risk of the position underlying instrument, the writer is required to deposit not only the margin required on the interest rate future contract position, but also the option price that is received from writing the option. The price of I hope this example is clear now. This is in the book. If you want, you can go through it. The price of a future option is quoted in 64ths of 1% par value. For example, a price of 24 means 24 by 64 of 1% of par value. Since par value of yearly bond future contracts is 100,000, 24, 64, 100 of 100,000 is 375. In general, price of future option is quoted at Q in equal to Q divided by 64 divided by 100 into 100,000. There are three reasons the future options have largely Supplemented options on fixed income securities is the options vehicle of choice for institutional investors who want to use exchange traded options. So why there are no physical options but future options? First, unlike why there are no options on the underlying treasury security but options on the futures? Why market participants prefer options on futures? First, unlike options on fixed income securities, options on treasury coupon futures do not require payment for accrued interest to be made. Consequently, when the future option is exercised, the call buyer or the put writer need not to compensate the other party. Second, future options are believed to be cleaner instrument because of the reduced likelihood of delivery squeezes. Market participants who must deliver an instrument are concerned that at the time of the delivery, instrument to be delivered will be in short supply, resulting in higher price to acquire the instrument. As the deliverable supply of future contract is infinite for future options currently traded, there is no concern about the delivery squeeze. Finally, in order to price any option, it is imperative to know all times the price of the underlying instrument. In bond market, current prices are not as easily available as price information on the future contract. The reason is that the bond trade is over the counter while the future are traded in the exchange. Thus, investor who wanted to purchase an option on treasury bond would have to call several dealers. In contrast, future contracts information is available at the exchanges. Let's talk about over-the-counter options. Not a lot, just this. Institutional investors who want to purchase an option on treasury security or a specific treasury security or a GNME pass-through security can do so on the over-the-counter basis. There are government and mortgage-backed security dealers who make a market in options on specific securities. OTC options, also called dealer options, usually are purchased by institutional investors who want to hedge the risk associated with a specific security. Typically, the maturity of an option coincides with the time period over which the buyer of the option wants to hedge. So the buyer is not concerned with the options liquidity. In the absence of the clearing house, there is now a counterparty risk for both parties. In case of the forward contract where both parties are obliged to perform, both parties face the counterparties. In contrast, here only the counterparty risk is for the buyer, not for the seller, because seller already paid his obligation, which is the option premium. Now for the buyer, the seller must perform. That's all about these interest rate options. I hope this makes some things clear. Thank you.